Abenomics is an economic policy framework introduced by Japanese Prime Minister Shinzo Abe when he came into office in December 2012. The term Abenomics is a portmanteau of Abe and economics. This policy framework aimed to revitalize the Japanese economy, which had been experiencing prolonged stagnation and deflation for many years. Abenomics is characterized by three main pillars. 1. Monetary policy. The first pillar of Abenomics involves aggressive monetary stimulus measures implemented by the Bank of Japan, BOJ, to combat deflation and stimulate economic growth. This includes the adoption of a quantitative easing (QE) program, where the central bank purchases government bonds and other financial assets to increase the money supply and lower long-term interest rates. Additionally, the BOJ pursued a policy of setting an inflation target of 2% to combat deflationary pressures and encourage spending and investment. 2. Fiscal policy. The second pillar of Abenomics involves expansionary fiscal policy measures aimed at boosting domestic demand and supporting economic growth. This includes increased government spending on infrastructure projects, social programs, and other initiatives to stimulate economic activity. However, Abe also aimed to address Japan's high public debt levels through measures to increase tax revenue and improve fiscal discipline over the longer term. 3. Structural reforms. The third pillar of Abenomics involves implementing structural reforms to enhance Japan's long-term growth potential and competitiveness. These reforms aim to address structural issues in the Japanese economy, such as rigid labor markets, inefficient regulations, and barriers to innovation and entrepreneurship. Key areas of focus include deregulation, corporate governance reforms, labor market flexibility, and initiatives to promote women's participation in the workforce. Overall, Abenomics represented a bold and comprehensive economic policy approach aimed at breaking Japan out of its economic malaise and fostering sustained economic growth. While the policy framework has had some success in boosting asset prices and short-term growth, its effectiveness in achieving lasting structural reforms and achieving sustained economic growth remains a subject of debate among economists and policymakers.